Good day, students. You're welcome to this class. So this is continuation of the topic we started last week, which is company accounts. And don't forget, in our previous class, we discussed introduction to company accounts. We're able to discuss the kinds of companies that exist. Then we talked about the characteristics of companies, talked about the types of companies and the document needed in the formation of a company. So we rounded the class with the issues of shares, and I believe we all understand what issues of shares means. It is the share capital, that is the capital used in the formation of a company. Alright, so in this class today we'll be talking about the quoted companies, the unquoted companies, and we'll be rounding up with the final account of companies. So when we talk about quoted companies, what is a quoted company? Now, a quoted company is a company whose shares can be bought or sold on the stock exchange. We are talking about companies that are registered, that is, companies that are listed. We can take for example Dangote Flour Mill. If you notice, if you check Dangote Flour Mill companies, you see that the companies always usually ends with PLC. If we check United Bank for Africa, that's UBA, it ends with PLC. We have Sterling Bank PLC. We have a number of them. So, and they can be referred to as listed companies. So the share price of a listed company is quoted and it is traded on a stock exchange. Now let me explain what stock exchange means. You know, stock exchange is a market in which securities are bought and sold. Don't forget, in our previous class we talked about share capital. And when we talk about share capital, we are saying that capital is the unit of, it's a unit of capital of a company. I mean, share is a unit of capital in a company that is allocated to an individual. And you know that the capital is the money used in starting a business. So, and the difference between, because I knew last class we were able to start the whole section by discussing about the types of businesses that exist. And I'm sure I remember I explained that we have some types of businesses that exist, which are the sole proprietorship business. And for sole proprietorship business, it is the owner, that is the sole proprietor, that puts or drops the capital. He invests his money, he or she invests his money in the business. While for partnership business, we have from 2 to 20, which the partners comes together to drop the capital. Now for quoted companies this time around, or for companies, so to say, before we move to quoted companies, for companies we have association of people, that is, people coming together to pull the capital together. And we are saying for quoted companies, now we are saying quoted companies is a company whose shares can be bought or sold on the stock exchange. That is, the set of people that are coming to buy the shares. For companies that they can buy their shares on the stock exchange are termed, or they are called, quoted companies or listed companies. There are some requirements that companies have to meet before they can be listed in the stock exchange. I believe you could see a good example of the stock exchange here. You can see a number of people. These are the number of people that are working there. It is usually like an open office where you find speculators, where you would find people that will be able to forecast about shares. So if you want to get a share, or if you want to get shares in a company, this set of people would be the one to advise you. They will be the one to put you through and the likes like that. So shareholders get shares of companies in stock exchange, and the kind of companies you could get on the stock exchange market is what we term as quoted companies. So I move to the next part, which is the unquoted company. And the unquoted company, we are talking about those set of public companies with the issued shares of stocks that are not traded on or quoted on formal exchange. You know, we are talking about, this is the direct opposite of the quoted companies. Quoted companies are the set of companies that you could get their shares on the stock exchange market, while the unquoted, you can't get it on the exchange market. However, their stocks are traded over the counter. Now this may result from the company being delisted. It's possible that a company was formerly listed, was formerly quoted, and they are no more quoted, or maybe due to reduce, or it could cause, they could actually leave the market, that is, they could be delisted due to regulatory oversight and compliance obligations that result from being exchange traded. It could be the regulators that would tell them, that is, when I'm talking about regulators, it could be people, probably the Apex Bank. Take for instance CBN. CBN is the Apex Bank, that is the bank of all bankers. That is, they could give a rule that, okay, for this so and so. Take for instance, let me give an example of the bank that we are conversant or familiar with. Take for instance, we have Diamond Bank. I believe you can still remember last year, sometimes last year, that was 2019, there are some rules that came up in the market, and then it happens that Diamond Bank was about to lose their trading mark, so they could not continue in the market again. So therefore, the other bank, which is Access Bank, came over and they merged with Diamond Bank. So those are the instances. So they could, it is possible that they did not meet the requirements to be listed. So those set of companies are called, and in those companies which they are no more, they don't have their stocks traded on the stock exchange, are the set of companies we call uncoated company. And taking it again, a public company with issued shares of stocks that are not traded or quoted on formal exchange but are traded over the counter are called uncoated companies. Alright, so now let's move to the final account of a limited company. And we need to understand that in a limited company, the following accounts will be prepared at the end of the year. These following accounts are the set of accounts we call the final accounts, and they are the trading profit and loss account, we have the appropriation account, and we have the balance sheet. I'm sure by the time you see all of these accounts, there will be some things that will be that would seems familiar, like the trading profit and loss account. I'm sure you must have seen trading profit and loss accounts over time. By the time when you were preparing your final account of a sole trader, I'm sure you must have encountered this account, and trust me, there is no changes to what you used to know in final account of a sole trader and what you're seeing here. And the appropriation account, I'm sure you must have seen appropriation accounts while you were preparing your partnership account as well. So there is really no change, or there's no significant change also. And the balance sheet still remains the usual balance sheets that we used to know. It is used to determine the statement of financial, it is used to determine the financial position of the business, and it is an expression of the accounting equation, which is asset is equals to capital plus liability. Alright, so we're moving to the next part, which is the format of the first account, which is the trading profit and loss and appropriation account. Now, when we're talking about the trading profit and loss account, the trading profit and loss account of limited liability is similar with those of partnership and sole proprietorship. And the main aim of trading profit and loss account is to be able to determine, for the trading part, the main purpose is to be able to determine your gross profit or gross loss. Now, for the profit and loss account, the main aim of preparing that account is to determine your net profit or net loss. Now, if you have to prepare, the format goes thus. As you can see, the first thing we are preparing or we are showing is the title of the account we are preparing. Because if you are preparing any account, you're expected to show the title of the account first of all. And please, you have to take note of the currency you are using. If it is Naira, you have to put Naira. If it is dollar, you have to put dollar. If it is any currency, ensure you put your currency there, please, because all those things attract marks. Alright, so I'm drawing my T format. And the first item that I'm seeing here is my opening stock. The opening stock represents the amount of stock, that is the amount of goods I have in my business at the beginning of the period. Alright, I'm moving to the next part, which is my purchases. Now, this set of account or this format is used for an existing business. Take for instance, I have been trading over time. The name of my store, for instance, my name of my store is Scholars Bookstore, and you will agree with me that in Scholars Bookstore, as at yesterday, I had some goods that I have in my store. So today, by the time I'm opening my store, the goods I have in my store at the beginning of the day is what I call my opening stock. Now, my purchases are the goods, represent the goods I've gone to purchase for resale, and it contains the amount of goods I've purchased both credit and it involves both credit and cash purchases, and it does not include purchase of fixed assets. Please, you have to take note of that. Purchase, I'm taking it again, contains my cash and credit purchases, and it does not include the purchase of my fixed assets. I'm taking the next part, which is carriage inward. Carriage inward is more or less my transportation expense. That is the transportation costs that I've incurred on the purchase of the goods. That is the cost I've used to transport the goods from wherever I'm buying it to my store. That's my carriage inward. So I will add my carriage inward, that is my transportation, to my purchases. So as soon as I add that, the next item is my return outward. Return outward is the amount of goods I'm returning back to the supplier after I made purchase. Take for instance that I purchased 10 carton of goods, and I realized that one carton out of the 10 is bad, or something has happened, maybe the seal has broken, and I'm returning it back to them. For the fact that it's going out, I'm returning it back. Definitely you don't expect that I should be paying for 10 goods again because I have returned one. So I should be paying for 9 goods this time around. So I have to less my return outward from my purchase value. Now I've gotten a net value for my purchases, which is this. That is, after adding my carriage inward to my purchase and taking out my return outward from my purchase, the net purchase, if I add it to my opening stock, I should have my cost of goods available for sales. That is what I'm saying is, at the beginning of the period, I had, take for instance, I had 2, and that's my opening stock, 2. I purchased 10, carriage inward, I've added my carriage inward, that's 10, and I take out 1 from my 10, which is 9. So 9 plus 2, that is 11. That is the goods I can now sell. They are now 11. Alright, I move to the next part, which is my less closing stock. By the time I'm taking out my closing stock represents the goods in my store at the end of the period, that is at the end of the day. Okay, now I'm done with my I'm done with the business of the day. I'm closing out, and the store, the goods that remain in my store, I think I have 3 cartons of goods. Definitely that means I must have sold, if I have 3 out of 11, that means I must have sold 8. So that 8 remainder, which is what I have left, is my cost of goods sold. That is, I have sold 8. And don't forget that this is trading account. From our elementary classes, we discussed that trade is buying and selling of goods or services. And you would agree with me that if you want to determine your profits, that is, if you've gone to bought something, I bought something, I bought 8. I bought something 8 cartons, and I sold it for some particular amount. I should be able to determine my profit. Okay, I bought something worth 8 naira, and I'm selling. I sold it for 15 naira. I should be able to determine my profit, and you will agree with me that my profit is 7 naira. That is, I'm taking out my purchase from my sales. So by the time I took out my purchase from my sales, I would get my profit. So exactly what we are doing here, I'm taking out my cost of goods sold from my sales. And don't forget, this represents the purchase cost of goods. That is the cost I got the goods. This is, so I have to get my sales value. Now to get my sales has to be on my credit side. My sales, and the only thing that could affect my sales is my return inward. Well, return inward, sales represent the amount of goods sold, both cash and credit sales, and it does not involve sales of fixed assets. And my returns inward is the amount of goods I've sold out and they have been returned back to me. So that's return inward. So I will take out my return inward from my sales to get my net sales or turnover, and my net sales or turnover. Now I've gotten my sales, I've gotten my cost of goods, which represent my purchase. So by the time I take out my purchase from my sales, I should be able to determine my profit. That is, if purchase is not up to or is less compared to my sales. Now if my sales is greater than my purchase, that it has to be a loss. That is, take for instance, I sold the goods I bought 8 naira, I'm selling it for 6 naira. So you'll agree with me that I've made a loss of 2 naira. Or if I am selling goods that I bought 8 naira, but I'm selling it only for 15 naira, you'll agree with me that I've made a profit. So that is what I'm trying to explain here. So by the time I add up my gross profit to my cost of goods sold, I would get my net sales, which makes this whole thing balanced. Now I'm moving to the next part. Now at this juncture, I've been able to capture the entire trading account section. So I'm moving to the next part, which is my profit and loss section. And for the profit and loss section, it is a continuation of my trading account section. So I have to bring down my gross profit down here. So my gross profit, I have to bring it down, which is 7 naira. I'm taking it down here. Now for the profit and loss section, the only items or the two elements on my profit and loss account are income and expense. So income on my credit side, expense on my debit side. So I have to recognize all my income and recognize all my expenses. Expense on the debit side, so I could have expense of wages and salaries, rent and rate, depreciation of assets, the director's remuneration, auditor's remuneration, hire of plant, advertising, debenture interest, insurance, and all other expenses that you could think of. And on the credit side, I could have my incomes to be income from quoted investments, rent receivable, discount received. When I say income from quoted investment, I'm saying, thank God I've just explained quoted investment some while ago, and I said they are like, take for instance, you have a shares in a company, you have a shares in Zenith Bank, you have a shares in Nestle PLC. Of course, at the end of the business, at the end of the year, you'll be given a dividend, some amount of money. So all those kind of incomes are the income we refer to as income from quoted investments. So if you have incomes, you would you are expected to show them on your credit sides. So at the end of the day, your expense and your income, you have to compare the two. If your expense is greater than your income, so that means you're having a net loss. But if your income is greater than your expense, that is, you received, let's say, take for instance, you received 15 and you paid out, or you paid out 10, so definitely you'll be having a net profit of 5. So in that case, your account will be balanced, and that is the end of your profit and loss account. Now you have to take note that due to the changes in accounting field, they don't call it trading profit and loss account again, but for the sake of our syllabus, you won't be penalized for that. So rather call it income statement or statement of income and other comprehensive statement of profit or loss and other comprehensive income. So for people that want to consider taking accounting as a career. Alright, so I'm moving to the next part, which is the appropriation account. And appropriation, when we talk about appropriation account, it refers to a breakdown of how a firm's profit are divided. Now we are saying, don't forget, it's a company account, and at the end of the day, they must have made a profit or loss. So the question is, how are they going to be distributing, or are they going to be sharing their profits? Are they going to be giving dividend? Dividend is the amount of profit that they share to their shareholders. Are they disposing dividend? Are they retaining the profit? Are they keeping it in the business? What are they doing with it? So that is what we are showing in our appropriation account. So the first thing, don't forget the title of the account. You draw your T account, then you have to bring, you don't forget that your net, if it is a profit, your profits will be showing on the debit side of your profit or loss account. Then you have to take it to the credit side of the appropriation account. So if you have, if the company has profit from the prior year, that is the previous year, take for instance, this is 1996. If they have profit from 1995, so they have to bring the profits here too. So that will be your balance brought forward. So the profit for the year would be net profit brought down. So we move to the next part. Now the question now is, how are they, don't forget, appropriation account is telling us how are they breaking down, or how are they distributing, or how are they dividing their profits. Okay, they could be paying tax, corporate tax, because it's a company. Don't forget, at the beginning of this class, I said one of the major characteristics of company is that it is a legal entity. It is seen as an artificial person in the face of the law. So one of the major characteristics of company is it's paid tax. they are supposed to pay corporate tax, and tax has to be paid out of profits. So that's the expense. That's the number one thing. The second one, we could be general reserves. Reserves are when you are keeping money in the business for some specific things. So we have general reserve, revenue reserve, dividend, interim, proposed dividend. Those are the, I've explained dividend, goodwill written off. If you want to write off goodwill, you could do that out of the amount of your profits you've made. We have preliminary expense written off. Preliminary expense is like it's one of an example of fictitious assets of the business. I'm sure you must have. I'm sure you'll be hearing this word for the first time. Fictitious assets. Now, fictitious assets is one of the kind of assets that, okay, take for instance, we have an example of fictitious assets, preliminary expenses, and those are the kind of expenses that must have been incurred in the business even before the business commence operation or commence business at all. And usually it is always seen as an asset, or it is always recognized as an asset in accounting. And at the point when you are writing those kind of asset of, it's supposed to be taken out of profit. So that is why we are showing it here. That's why we are recognizing it on our preparation account. So by the time we add up all the expense and take it out from our profits, the remaining profits will be the retained profits carried forward. So I'm moving to the next part, which is my balance sheet. And don't forget that the balance sheet is to show the accounting equation, which is asset is equals to capital plus liability. And my balance sheet, the first thing you have to take note is give us the title of the account you're preparing, which is balance sheet as at 31st December. Don't forget, for trading profit and loss, it is always trading profit and loss for the year ended. For balance sheet, it is balance sheet as at. The reason why we have for the year ended is because profit and loss shows the operations for the period, while balance sheet shows the position of the business over time. Alright, so I'm moving to the next part. Now on our balance sheet, don't forget that it's showing the accounting equation, which is assets equals to capital plus liability. So what I'm showing here is assets is equals to capital plus liability. So I have to show all my capital, and for the capitals that I have here, I explained the last class. I explained the share capital, and on the share capital, I believe I explained the authorized capital, the issued capital, the called up, and the likes like that. So the two set of capital that you are expected, and this is the major part of this account, of this final account, and this is what makes the difference, or this is what brings about the difference between company's final account and sole proprietorship or partnership final account, because of their capital structure, because it is the capital structure that distinct them. Now, when we talk about the capital structure in company account, don't forget I mentioned that we have authorized capital, that is the amount of capital that is listed or that is stated in the memorandum of association. And for the authorized capital, usually it has to be balanced. Usually it has to be balanced because you are not selling anything out of the authorized capital. Now the part that you are selling is what we call the issued share capital. I believe you still remember that is the part that the public can come to subscribe to, is the issued share capital. Now for the issued share capital, is the one that will represent the amount of the capital for the period, and we have the ordinary share, we have the preference shares. By the time we take the issued share properly, you'll be able to understand the difference between the ordinary share and the preference share. Alright, so I'm moving to the next part. We have reserves, we have share premium, retained profit, and the likes like that. So those are the things. All of this represents the profits that we have earned, probably due to sales of shares or due to the operations of the business. Now when you add the profit to the capital, don't forget usually what you're supposed to do is to add the profit to the capital to increase our net worth, and at the long run that gives us our capital, and we are supposed to add our liability to our capital to give us our assets. So thereafter we take all our liabilities, we'll take the debentures, bills payable, sorry. Now for the debenture, we said the debenture is more or less like, okay, when companies are getting loans from individuals. So debenture, and then for debenture is loan notes. So debenture, then bills payable, income in advance. We have creditors, we have proposed dividend, we have expenses, accruals. So all other liabilities that you could think of. So by the time you add them up, it's supposed to give you your asset value. And for the asset value, you're supposed to get fixed assets. You add up your fixed assets, to your current assets to all other forms of asset that you could have in the business, which are probably goodwill, stock, current asset, and the likes like that. So by the time you sum up all your assets together, it should give you your capital plus liability. So that's the format, that's the typical format of the balance sheet.